Today I want to look at the investment case for Sandstorm Gold because the company's stock price has taken a beating at the same time that gold is hitting all-time highs. So the stock price should be at all-time highs, all else equal. So today we're going to look at the company, see if we can try to figure out why it's trading at such a low price. It has a lot of debt, so we're going to look into whether the debt's a problem. And before the end of this video, I'm going to give you my investment recommendation, my target price, my investment time horizon, and the risk level for this investment. But with all that said, this is just my opinion based on my own analysis, and always do lots of your own research before investing any of your hard-earned money. First, I want to give a little overview of Sandstorm. Sandstorm Gold is a royalty and streaming company, so they don't actually operate any mines. Instead, they usually make an upfront investment to get a future portion of anything that mine produces. One of the big benefits of this is that they aren't subject to any increasing costs in the future that the mining company may face, but they get all of the benefit of the increasing commodity prices. And Sandstorm is highly diversified. They currently have 42 different assets that are cash flowing. And in addition to those 42 cash flowing assets, they also have 201 other assets that are in their development pipeline. So any one of these 201 other assets could be a cash producer in the future. But right now, the market is only giving Sandstorm credit for just a handful of these 201 other assets. So they have a lot of growth already built into their pipeline that they've already paid for. Another good thing about them is that they're highly profitable. They have 88% gross margins. So every dollar that they get from a royalty or stream, they get to keep 88 cents of that. Well, and then they have some general and administrative expenses on top of that, but those are pretty low as well. But 88% gross margins are huge. One of the great things about royalty and streaming companies is that they take very few people to run. In 2023, Sandstorm had about $180 million of revenue, and they did that with just 30 employees. So that is $6 million of revenue per employee with 88% gross margins. And now let's talk about their near-term growth. In 2024, Sandstorm guidance is for between 75,000 and 90,000 gold attributable ounces. But within 5 years, they expect that annual number to be at 125,000 ounces per year. So we've already talked about how we're going to see significant growth in the coming years, but now let's look at what the gross profit might be in various scenarios. So over here on the left-hand column, we have Sandstorm guidance. We have their low point of 75,000, their high point of 90,000, and then their midpoint of 82,500 attributable ounces. And then at the top here, we have the average gold price for 2024. Of course, we're at the beginning of 2024, so we don't know what the average gold price is going to be. But on the low end, I have 1,900. And then in the middle, I have what today's gold price is. And then on the high end, I have $2,300 per ounce. So let's say we come in at the low end of guidance and the gold price is only $1,900 per ounce on average. Well, then the company's gross profit, now keep in mind, this is after taking into account the expense of those royalties and streams, like what Sandstorm has to pay to that company to be able to receive that money. This is after taking into account that 12% cost. But anyway, worst case scenario, we're looking at $125.4 million. This is in US dollars, by the way. And let's say we come in at the midpoint. We come in at the midpoint of guidance, and the average gold price for 2024 is what the gold price is today as of the making of this video. We're looking at $155.7 million. And if we were to come in at the top end of guidance at 90,000 ounces, and the gold price was really strong at $2,300, we're looking at $182.2 million of gross profit. So these numbers that you see here are going to be their estimated cash flow before taking into account their cash expenses. So now let's take a look at what their cash expenses are. So this is what I estimate their cash expenses to be, not including debt repayment, because I want to look at, okay, if they make this much gross profit and they have this many cash expenses, how much money are they going to have left over? Number one, to pay the interest on their debt, and to pay down the principal balance on that debt. So I think their income tax is going to be somewhere around $5 million. I think their G&A, excluding share compensation, because share compensation is not a cash expense, G&A of $13.9 million, and dividends of $17.7 million, because the CEO has made it very clear that they have no intention to ever cut the dividend. So the dividend will be this or higher unless they were to buy back shares, because if they buy back shares and cancel those shares, well, then they don't have to pay out a dividend to those canceled shares. But this was the amount of dividends that they paid in 2023, and I expect that to stay the same in 2024. So we total up these cash expenses, and we're looking at $36.6 million. So let's say, for the sake of this example, that gross profit for the year of 2024 comes in at my midpoint estimate of $155.7 million. You take that number, you subtract their cash expenses, which also includes more than $17 million in dividends paid to shareholders, you come up with cash left over of $119.1 million. Now, this is the number that we're going to be using to pay the interest on the debt and also to pay down the principal balance on the debt. Before we talk company valuations, let's look at the company's debt. So they have this revolving credit facility of $625 million. And on this credit facility, they have drawn amounts and undrawn amounts. So drawn amounts is the amount of debt that they've taken on from that, and then undrawn is what's left. But there's an interest rate for both the drawn amount and the undrawn amount. So the interest rate on the drawn amount is the secured overnight funding rate, the SOFR, plus 1.875 to 3.5. And this range is based on the company's leverage ratio. And then on the undrawn amount, it's 0.442% to 0.788%. So we're looking at interest rates that the company is paying right now between about 7.2% to 8.8%. But I wanted more clarity on what the interest rate was going to be versus the current leverage ratio of Sandstorm. So I reached out to their investor relations department, and they said that that's not public information, but they can tell me that the company is paying between 7% and 8% on their drawn credit line right now. So basically, we can take 0.81% off of this 3.5, which means the maximum is now 8%. So it's somewhere between 7 and 8, but I know it's not 7. I know it's somewhere between 7.185% and 8%. And since they're no longer at the maximum leverage ratio, we can also assume that the undrawn portion is about a max of 0.6% there. And as of mid-February, the company had $419 million drawn on this credit facility, which puts their annual interest payment somewhere between $31 and $35 million. The company has said that during 2024, they plan to pay this down to at least $350 million. And when it's at $350 million, the company will have an interest payment somewhere between $26 and $30 million. Now, they're going to be paying this down with cash flow, this $119 million. So with this $119 million that they're probably going to make this year, they're going to have to use part of that to pay the interest on this debt, which will probably be somewhere around $31 million, which is down from about $40 million last year. So even if we were to come down on the very low end, the low end of guidance, and a much lower gold price, we're still looking at significantly more than enough money to pay the interest on the debt. So I don't think there is a concern at all of being able to pay the interest on this debt. There's plenty of cash flow left over, and they're very, very diversified. So even if they lost their very best asset, they would still have more than enough money to pay the interest on the debt. And that's even if we got some of the worst numbers here. And Nolan Watson, the CEO, said they chose this $350 million number because they think when they get the debt there, that their interest payment is going to be very manageable and it won't be nearly as much of a concern. And they think that about the same time they get the debt level down to $350 million, is about the time that the Federal Reserve will be cutting interest rates, which means the interest that they're paying on this debt will also be going down. And he has stated that until they reach this number of $350 million, debt reduction is number one priority and basically the only thing that they're focusing on. And after they get to this number, they're going to be splitting cash flow between debt reduction and buying back shares. And in addition to using this cash flow to pay down the debt, they've also announced that they're seeking to sell some non-core assets to help pay down the debt even faster. And before the end of 2024, their goal is to sell between $40 million and $100 million of non-core assets, every penny of which they have said is going directly to debt repayment. And they've also said that this is the cash portion. They've done a deal already where it was part cash, part shares, but they expect future deals of selling non-core assets to be only cash. And since they've already made a transaction, well, they still have 30 to 90 million left. So let's say they reach the maximum of their goal and they sell $90 million of non-core assets for cash. They've just reduced their debt from $419 million to $329 million, putting them below that $350 million mark, at which point they would start splitting their cash flow, their extra cash flow, in between buying back shares and paying down debt. And if they're going to spend like tens and tens of millions of dollars buying back shares, well, then that could do really good things for the share price. One question I had is, why would you sell non-core assets when, as a royalty company, you work so hard to try to get various royalties in your portfolio and build up the number of royalties you have over the years? Because eventually some of those will turn into cash flowing assets. But they have said that ideally when it comes to selling non-core assets, well, they have debt that they've issued to other companies, so other companies owe them money, and also they have shares in other companies. So they've said that they'd like to sell some of that debt and sell some of those shares to raise that $30 to $90 million. But if they have to, they will sell some royalties that they probably aren't getting any value for in the market. They have ruled some out. Now, they've looked at the royalties and they've said, okay, we consider this very significant to our future, or we think this one has significant exploration upside. So we're not going to sell these that are significant to our future or these that have lots of exploration upside. So we would consider selling these to raise that money. And they said they can easily do that. There's easily enough value there to sell that amount of royalties or debt or equity. But before they're making any of those sales, they want to make sure they're getting good value for it, which I think is a reasonable approach to try to reduce that debt level. And before we talk about valuation, I want to talk about why the stock price has gone down so much. Well, there's a few reasons that I see. Number one is just overall sentiment in the gold sector. I think a lot of investors are frustrated that they see the gold price going up and up and up over the years, but their gold stocks have gone nowhere. So then they're just getting frustrated and disappointed and going to buy Nvidia or something instead. Another reason why I think the stock price is so low is that in 2022, they were buying back shares, but then they decided to acquire a big package of royalties. And to do that, they issued more shares and they took on debt. And when they issued those new shares, they issued them at a lower price than those shares that they were buying back right before that. So there were some investors that didn't like that at all. When you look at a stock chart comparing the performance of Sandstorm over the last year or so compared to the other mid-tier royalty and streaming companies like Osisko Gold Royalties and Triple Flag, Sandstorm has underperformed like crazy. And I think a big reason for this is because they have so much debt. Most people who are buying a royalty or streaming company are doing it because it's a safe business model and these companies typically have rock solid balance sheets. So they're buying it because they think it's a safe bet that's going to give them a good return over the years. But when you add a bunch of debt onto your balance sheet, that makes it much more risky. And I think that a lot of the big investors are shying away from Sandstorm because of their debt levels. And more recently, a big reason why we saw a big sell-off in the stock is because of their Hod Maden asset in Turkey. Their Hod Maden asset is actually the biggest portion of the company's NAV at about 12% of the company's net asset value. Well, here's what happened. SSR Mining is the operator of Hod Maden, and this mine is in Turkey. And SSR Mining has a different, unrelated mine in Turkey, their Çöpler mine, which just had a massive landslide. So their stock price got absolutely killed, and investors in SSR Mining are afraid of what's going to happen with SSR's other Turkish asset, Hod Maden. Also, Sandstorm investors seem to be scared about that as well. Now, I don't think that's really a big deal because maybe SSR Mining lost their social license to operate in Turkey. But if that's the case, you know what? Hod Maden is just going to be sold to some other company, and some other company is going to build Hod Maden. But I do not doubt that this is going to get built. Maybe what's going on with SSR Mining delays the build a little bit. Maybe it doesn't. But let's say that what happened with SSR Mining delays the building of Hod Maden by 2 years. Well, that would affect the net asset value of Sandstorm by 1.2%, because Hod Maden is 12% of Sandstorm's net asset value, and then because of the time value of money, you delay it by 2 years, you're looking at 1.2% of Sandstorm's NAV that's taken away from you. So I think that was a big overreaction on investors' part to sell off Sandstorm by 10% on a move that might affect their NAV by 1.2%. And to be clear, I don't think that the SSR Mining fiasco at Çöpler is going to delay the Hod Maden build by 2 years. Because if SSR Mining loses the social license to operate, or if SSR Mining doesn't have the money to build Hod Maden, well then that asset is just going to be sold or transferred to somebody else, and it's going to end up in stronger hands. That's one of the things about these royalty companies that's really good, is assets tend to get into stronger and stronger hands over time. Because if one company doesn't have the money to build it, and it's a good asset, well, that's going to get built by another company one way or another. Okay, now let's look at the company's valuation today and where it could go in the future. As of mid-February, the company has just shy of 300 million shares outstanding at today's price of $4.63 USD. That puts the market cap at $1.38 billion. So how could the company be valued in the future? Well, in about 5 years from now, Sandstorm will likely be getting about 125,000 attributable ounces per year from growth that's already paid for. But that 125,000 ounces is actually on the low end of the projects that have already been announced. Now, that could be as high as 135,000 ounces, but in addition to that, we'll probably see expansions of some of their assets, making that number even higher over the next few years, especially if the gold price stays elevated. However, in addition to that, they have this option that they bought in the past, and this option on this Mara stream is well into the money. So they're going to exercise this option almost for sure, and that would bring their attributable production up to about 155,000 ounces a year. They say in 2029, but let's just call it 2030 to account for some delays. They're likely going to be receiving about 155,000 ounces a year. At today's gold price, if the gold price stays about where it's at, I expect it will be higher than it is today in 5 or 6 years from now. But let's just say it stays where it's at. That would put their annual cash flow at $332 million. So now let's take a look at where Sandstorm could go in the future. I'm going to put the investment time horizon at 6 years because I think by 2030, a lot of their big mines will be built that are coming up. And also keep in mind, at that time, there will probably be more projects of those 201 other assets that they already have that are more advanced and have a more clear timetable of going into production. So at that time, the market will be giving value for other assets as well. And now let's talk about my target price 6 years from now. So 6 years from now, I expect the company to be bringing in 155,000 ounces a year I'm going to just assume that the gold price is where it's at today. And then based on that, you have $332 million of cash flow. Historically, Sandstorm has traded at 17.4 times cash flow. However, let's say they trade at 13 times cash flow. That would put the market cap at $4.32 billion. Or if they trade at 17 times cash flow, that would put the market cap at $5.64 billion, which would be about 3 times the current stock price and about 4 times their current stock price, respectively. So the current stock price is $4.63, and this puts my target price at a low of $14.49 or a high of $18.93. Now, this is a pretty wild guess, but you have to do this to be able to have some sort of idea of the value of what you're buying. You'll never get it right. As Rick Rule says, you just have to get it more right than other people who don't put in this work. So now let's talk about the risk level. 1 being the least risky, 10 being the most risky. The royalty and streaming business model is very safe, especially if you already have a whole bunch of royalties and streams that you've already purchased. Now, it's a lot riskier if you don't have anything yet, but they have 240 some assets, 42 of which are cash flowing, and not a single one of their asset comprises very much of their cash flow today. So they're very well diversified. They have a safe business model. They have cash flow from 42 different assets, more to come. It'll be at least 44 by the end of this year that are cash flowing. So that makes it very, very low risk. They do get punished a little bit because of their debt levels. They have over $400 million in debt right now. I would put the risk level at 1 to 10, 1 being the safest if it wasn't for their debt. But since they get punished a little bit for their debt, I'm going to put the risk level at 3. So my recommendation for this between sell, hold, buy, or strong buy is a strong buy. As always, this is just my opinion based on my own research, and you should always do lots of your own research before investing any money at all.